Oh, sorry, guys. What's going on? Happy Monday. Happy Memorial Day for those of us here in the States. And welcome to a very impromptu dividend happy hour. I was just getting some work done here at the house. Very nice, relaxing day. But yeah, I just kind of had a little break in my day here. And I thought, why don't I hop on a live stream? I missed Friday. I wasn't able to stream with you guys, during our normal time last week. So I figured, why don't I just hop on, take like 30 minutes or so, 45 minutes, and spend some time with all of my compadres here in the dividend investing community. So yeah, super last minute, just decided on the fly, let's do a little live stream today, and hope that's cool with you guys. Looks like there's about 60 of us in the stream. Happy to see all of you guys, and thank you for tuning in. Yeah, like I said, just was kind of, I guess, bored at home and thought I'd come hang out with you guys. So I want to know, normally we have our little spiel here. We'll do our cheers and got a few questions for you guys. But really the only question that I have for you guys today is, which stock or stocks do you plan on buying this week? Now, the market is closed here in the United States for Memorial Day, so it's probably a very boring, very low-key day for a lot of us. I think a lot of us don't even know what to do with ourselves on these days when the market's closed. But yeah, I want to know, what are you guys planning on buying this week? And let me go through the chat here and just say what's up to everyone. I see Sergey. I see Victor, who it was his birthday yesterday. Victor, happy belated, my friend. Hope you had a great birthday. Chris is here just leaving the gym. We've got Daryl in the building. Fast Eddie is here as well. We got Thomas, first time in a while. Finally made a happy hour, first time in a long time. Well, good to see you, man. Sissam's here. JJ's here. Sigurd is here from Norway. My man Darth's in the building. What's up, Darth? We've got Boaz, DeHubs. What a nice surprise. I know. I'm happy to hear that. JB's here from Austria. What's going on? We've got Vasco planning to buy Pepsi and Merck tomorrow. Good pickups. Good pickups. Jeremiah's here. Ricardo. What's up, Ricardo? Rainer's here wondering about UNH. What exactly are you wondering about UNH? Is that what you're planning on buying this week, or what's the context there? Let's see. Jeremiah is picking up some FICO. That's a good one. There we go. David crossed over 1,000 shares of SCHD last week. Very impressive. Probably buy more this week. Good stuff. Yeah, Michael's picking up some Google and SPGI. SPGI, is that like, what is that one? Oh, S&P Global. Huh. Right? Yeah, S&P Global. Took me a second. Cool. Okay, Codex wants to know about FDP. Fresh Del Monte. Okay, we'll take a look at FDP. We'll save that one real quick. And by the way, guys, if you guys have any stocks you want to look up or any investing questions, drop them in the chat here. We'll probably run this stream for about 30 minutes or so. Just a nice and quick one today, because I got to get back and finish some work. I was working on a little bit on my newsletter this morning. I'm taking a break right now to do this and hang out with you guys, and then I'm gonna hit the gym right after this, and then come back, and I've got to finish working on my newsletter. So pretty low-key day though. Nothing crazy going on. Already got my run in earlier this morning, which is nice. Little 5 miles. Let's see. Let's keep going. Sigurd's planning on buying Pepsi and Nike. Nice. Mark with some Otex. Very cool. Kevin Burgess is in the building. What's up, Kevin? So Kevin, I just saw this right before I went live. Kevin is going to be on Russ's live stream tonight. I think at 7 Central, if I have that time right, which is 5 p.m. Pacific time, 8 p.m. Eastern time, if I have that time right. I'm going to try to tune into that. And you guys should do the same. Let's see. DeHub's going with SCHD, Kroger, and Google. Very nice. Salmon with BNS. Okay. Ricardo thinking Hercules. Nice. Ooh, Swampy, BMY. Bristol Myers is on the list. There you go. Darth says COF. Is that Capital One? Yeah, it is. Okay, nice. Let's see. Let's take a look at, we'll take a look at Capital One. It's been a long time since I've done that. I don't know. Let's see if we pull it up on SnapStock. What does it show us here? Bear with me, guys. Yeah, okay. Yeah, we'll take a look at it. We will take a look. Mr. Swack's got a question about Intel. Okay. Let's see. Yeah, Capital One. So are they acquiring Financial or Discover, or are they just merging? I mean, I guess if they're just merging, one's always on top and one's always on bottom. So it is kind of different names for the same thing there. Yadik wants to know about Coca-Cola. I think we talked about Coca-Cola last week or a couple weeks ago. Okay. I don't know. I'm not quite familiar with what this is. Going to do the test that Russ put out there the other. Huh. Okay. Well, anyway, guys, let's go through some of these. So Codex wants us to check out FDP. So, and I'd never heard of this company until you just mentioned it. So this is, oh yeah, I know this company. Okay. I've heard of them. I know that logo. Let's go over here. Hide the comments. So FDP is Fresh Del Monte produce, as we can see here. Very solid year, actually. Up 53% in the last year. Wow. Snap score sitting at 5.3. And I want to switch this view. Bear with me, guys. There we go. I like that one. Okay, so looking at the snap score here, we've got growth at a 7. That's pretty solid. So probably seeing some nice revenue, earnings, free cash flow growth. Low profitability. Very nice debt, nice dividends and buybacks, low capital efficiency. Okay, so pretty average from top to bottom across the board. So, okay, so interesting that this is getting I mean, I understand why it's getting such a high growth score, 7 out of 10. And it's easy to see why these CAGRs are so high here, because going from, 2019, 2020 to now, we do see an upward trend here with the exception of 2023 here, looking at the earnings. Free cash flow, yeah, we're seeing an upward trajectory. But prior to that, free cash flow looks like it was trending down. So I don't know. I'd have to dig a little bit deeper to get a better understanding of maybe what happened within these years or I guess here to really cause this big jump. That's something that I'd like to see. The revenue growth rate is negative. Looking at the last 5 years, over the last 10 years, it's slightly up. So really not an aggressive grower, which is okay. But I'd like to get some more context here and see what's happening in the earnings and free cash flow department, and just maybe understand a little bit more about the company. That probably would help paint that picture for me. Looks like margins are increasing over time, which is good to see. Very good to see. I mean, they're low, in their own rights, at 8.5% gross profit margin, 3.5% net profit margin, and, about the same here with the free cash flow margin. So that's why the profitability score is so low. But the situation does look to be improving. They are slowly but surely increasing their margins over time. So I like that trend. Yeah, net debt's going down. The net debt to free cash flow is in a good spot, 2.9. Decent interest coverage as of last year, but prior to that, the interest coverage does look a bit low. So even though it's fine for this last year, I would like to see it consistently about in this range. And so we'll just have to see how that plays out moving forward. But yeah, overall, it doesn't look like a terrible debt situation. I don't mind this at all. And it looks like it was under 5 for these last few years. So I am happy to see that. Let's see. Why does FDP go 3 years up and 1 year down? Don't know what. Sorry, guys. I'm just checking out what I missed here in the chat. Ooh, I see Casey General Store. I love Casey's. Mark, what are you referring to here? What metric are you referring to there? Now, anyway, looking at the dividend stats, these look pretty solid. Very solid, actually. Nice 3% yield, very high dividend growth rate, and that dividend growth has been pretty off the charts since 2019. Looks like they did cut it in this year here, but that's looking good. And it looks like the dividend growth has been picking up over these last few years, actually. Now, with that, what has the payout ratio done? Negative in 2023, but that's because they have had negative earnings per share. Other years, it looks to be pretty low. So that dividend looks to be pretty well covered. As far as the free cash flow goes, there were a couple years where it got kind of questionable. But for the most part, it looks like the free cash flow payout ratio is very low as well, like under 30, 35%. So yeah, I like that. And they, as aggressively as they're growing it, they still have room to continue doing so with that low payout ratio. I don't know. I'm really torn on this one because the revenue's flat, margins are increasing, so that's good. The profitability situation is getting better over time. I don't know. I need a better understanding of what happened in these years. But I like this. I like seeing the big jump in free cash flow, and it's happened over the last 2 years. It's been up like this. So we'll see if they keep it going. But if they can, if they can continue this trajectory right here, that's fine by me. I mean, things will be looking pretty good. If they can continue this right here and, this trend over here, keep growing that free cash flow per share, then that dividend growth should continue as well. But we'll see what happens. Interesting, though. I'd never looked at this company before. I mean, they're in the consumer staples sector. Fresh cut fruits and vegetables. Those are not going to be going out of style anytime soon. But not a super aggressive grower in the top line. So I don't know. It looks interesting. There's a lot of good with this one. This is just really throwing me off here. This is throwing me off. But I would say generally I like the earnings trend with the exception of this right here. But generally the earnings per share trend since 2019 has been good. So yeah, I think there's more good than bad with this one. But yeah, let's move on. Let's move on to the next question, guys. Let me see what I missed here in the chat. Okay, talking about the net profit margin. So why is the net profit margin up 3 years and down 1? Well, so I think you're talking about right here. It was going up for these 3 years, but then it dipped into negative territory here in 2023. It's because they had a negative earnings per share. So if they have a negative earnings per share, that's going to push the margins down below 0% as well. But we can see that it jumped right back up into positive territory in 2024. So yeah, this is only negative because of what we're seeing here in the earnings per share. And we'll see, I mean, as you can see here in 2018, they also had negative earnings per share. And we also see that as a result, they had negative net profit margin. So it lines up there. Let's see. Ooh, good question about dividends versus growth. Okay, let's go to Mr. Swack's question here. He says, should I dump Intel? Should I dump Intel for a $400 loss? What do you think your crystal ball says about their future? I got about 15 years until retirement, own about 60 shares of Intel. So I don't know definitively what you should do, but this is how I would look at it and try and make a decision. So I personally, so okay, just a little backstory. I used to own Intel. Owned it for a couple of years. I ended up selling out of it just for actually a pretty decent profit out of luck, out of sheer luck. Just timed the exit nicely and made a pretty nice profit on Intel. But I sold because I realized, I don't really get the semiconductor industry. I understand that it's an important one. Chips are, pretty much everywhere at this point. I'm looking around at, here in my office, pretty much everything that my eyes go to, whether it's the lights or my computers here, or my audio interface, all have some sort of, chips in them. And so I understand it's a pretty important industry, but I realize I just don't really understand what makes an Intel chip better than like an NVIDIA chip, or versus an AMD chip, or now versus like an Apple chip. So I kind of came to the conclusion that this is just a bit over my head, and I probably shouldn't own any of these companies. There's other things I could probably put my money in. And hold on, guys. Someone's at my door. One sec. Checking my little doorbell cam. Bear with me. Okay. Looks like we got a package. There we go. Sorry about that. So anyway, as I was saying, that's what prompted me to sell Intel. And with that said, kind of to answer your question, I just don't know. I just don't know about their future. I really not super well versed in that industry. It's a bit complicated for me, so I don't really spend a whole lot of time with it. But I would say if that situation, if you're kind of coming to a similar conclusion, then it's probably not a company that you should own. And there may be some concerns here about selling Intel for a loss, which I totally understand. But I do think, I think that if you can think of a better place to put that money, then maybe unlock it from Intel, which you may not be sure about, and put it into something else you maybe have more of an understanding in, or more conviction in. At the end of the day, even though it sucks to lock in a loss, $400 is not going to, it's not going to completely wreck you. It's not going to be a life crushing amount of money. So you'll definitely survive and recover the money lost from Intel if you should decide to sell and reinvest elsewhere. But yeah, I would just think about that. Like, do I think that the future for this business is looking positive? And I don't know, just like some of the stuff that I'm seeing in the financials, and they could turn it around. I guess like that's kind of the big question with Intel is, can the business turn around? But some of the things that I'm seeing, I'm glad that I sold. It's just not something that I'd want to, this isn't looking that great. Why would I own something like this when I can own more Visa, for example? Totally different businesses, I understand. But why would I want to own this? Losing money, losing net income, losing free cash flow, revenues declining. Yeah, obviously they cut the dividend, so just not a company that I personally would want to be in. Yeah, it's the police. Okay, let's see what else we got here. So this next one's from Deke. Thoughts on Coca-Cola? I've been hearing that it's overvalued since it was in the high 50s, but the share price keeps climbing. Yeah, let's take a look at some of Coca-Cola's financials. Like I said a few moments ago, I don't think it was last week, but I think maybe a couple weeks ago or a few weeks ago, we ran through Coca-Cola, and yeah, pretty crazy to see where the share price is now, in the low 70s. PE ratio is sitting at about 30. So it does look like you're definitely paying a premium. What's going on with their free cash? In trailing 12 months, it dipped into the negative according to this. But yeah, it does look like you're paying a premium for Coca-Cola. Now, with that said, it's been a pretty consistent grower, at least since 2020. These last few years, the sales have increased after a few years of stagnation or slightly declining sales. So it does look like things are trickling back up, growing at a pretty decent rate. Earnings per share has grown pretty consistently as well. Free cash flow, I don't know. Free cash flow has been consistent. It has slightly grown. Last year, it did take a dip. So we'll see what 2025 looks like. But historically, Coca-Cola has been a very safe investment to own. Very stable margins as well. Debt situation might be a little bit high. A big jump in the net debt to free cash flow in 2024, which is no surprise because the free cash flow per share did take a dip. But prior to this year right here, it looked to be in pretty good shape. Interest coverage was okay. I mean, Coca-Cola's been around long enough that they know how to manage their balance sheet, I'm sure. And you're getting a dividend king. So generally speaking, you're getting a company with a very solid history. It does look like the payout ratios are a bit on the higher end, usually. But once again, this is a dividend king, and they probably don't need a whole lot of their net income or their free cash flow to reinvest back into the business. So they don't need to hold on to a lot of their earnings or free cash flow. So that could explain the higher payout ratio. But what do I think about Coca-Cola overall? I think it's a bit expensive right now. It looks to me like you're paying a bit of a premium for a company that's already seen, a pretty juicy run up 20% in the last year, up 17% just so far here in 2025, these last 5 months now. So it looks to me like you're paying a pretty high price for a company that's historically not been a very solid grower. Comparing it to Visa, which I know once again totally different businesses, totally different industries, but I just wanted to compare the PE ratios. And I think Visa's an equally high quality company, equally as high quality as Coca-Cola is what I'm trying to say, if not more. And based on the Snap score, it's looking to be much better in all regards. But the PE ratio, you're getting a 31, so it's a bit higher. You're getting about a 10% higher PE ratio, but you're getting much more consistent and aggressive growth in the company with higher margins, more favorable debt situation. So there was, and albeit you are getting a lower starting yield, less than 1% compared to Coca-Cola's 2.5%, 2.7%. So I guess there's the trade-off. But I guess all that's to say, I do think that there are other companies out there I'd rather own. I probably would rather own Pepsi at this point. And actually, let's go back over here. Just from like a price action point of view, Pepsi is seen, it's pretty much gone in the opposite direction as Coca-Cola. And these are very similar businesses, obviously. So you're getting a very similar business at a much better valuation. And similar growth, I would say. Pepsi, this is the one thing with Pepsi from what I can see, and let me know if fill in any gaps for me here in the live chat if you guys want to, but the big red flag with Pepsi is that in 2024, their free cash flow payout ratio jumped up over 100%. So they were officially paying out more in free cash flow than they had generated, which if they keep that up, that's going to be a problem. But otherwise, I think Pepsi's looking really good. I think the Hershey company is another very, very solid option in this space. I would say that, and I don't think it's too different from something like a Coca-Cola or a Pepsi as well. And I would say out of the three, the Hershey company is probably my favorite one, just from a financial standpoint. So, and I think the yield's higher than what you're getting with Coca-Cola, a little bit lower than what you're getting with Pepsi, but the growth rate I think more than makes up for that. It's been a very nice dividend grower. So that's kind of my take on the whole thing. Let's see. I want to see what I missed here in the chat. Okay. And then Hershey company, obviously, still dealing with high cocoa prices. Yeah, I would agree with this. Let's see. Yeah, MB says agree on Coke. It's about 2% of the portfolio, but no desire to add more at current levels. Much love from Ireland. Nice. I'd love to go to Ireland someday. Love to get a pint in Ireland. I'd love that. Okay, guys, I have one more question here, and I want to hear from you guys on this one. I think this is a really good question. This is one that that we come across from time to time, and I think there's a good reason this question pops up time and time again because it's one of those things that's very hotly debated, and definitely different schools of thought on this. And the thing that I will start with, once again, I want to hear what you guys think about this in the chat. But the thing that I will start with is I think that there's a big misconception that you have to be either or in this situation. So for those of you who maybe aren't looking at the screen right now, the question is, hey, Ryan, would you advise a younger person to go in dividend investing or into growth? And I'm actually going to screenshot this question because I think this would be a good one to cover in a future newsletter or future video or something. So thank you for the question. But okay, sorry, got distracted for a sec. So I want to start with this and say, I think that one of the common beliefs is that these two are mutually exclusive. You either have to invest in dividend stocks or you have to invest in growth stocks. And if you haven't already, I think you guys will come to find that a lot of things investing are made to be black and white. It's either or. It's always or, not and. And I think the reason for that, I won't turn this into a tangent because it's not super important, but I do think generally speaking, this is something you'll see a lot. I think it's just easier to put labels on things. You hear it with value and growth. You either buy value stocks or you buy growth stocks, or dividend stocks and growth stocks. But I don't think the two are mutually exclusive. I think that you can invest, and this is how a lot of us do it. This is how I think about it. I try to invest in dividend paying stocks that are growing. So, and I think that's a good way to go for any investor. I think that this type of approach is good for young investors, old investors, investors of all shapes, sizes, and time horizons. And I think when you get to the point, when you really get to the root of what investing is, it is to buy companies that will be better tomorrow than they are today. And by better, we mean, bigger, stronger, faster, generating more sales, more profits, more free cash flow. And I think when you get to the whole root of investing, it's to buy growing companies. And so I think that growth is something that you want to look for, no matter what. As a buy and hold investor, no matter what, I think you want to look for growing companies. Now, for me personally speaking, not everyone does this, but for me personally speaking, part of my criteria is to only invest of those companies that are growing, is to only invest in those that are paying a dividend. And that's just how I roll. I like to get that cash flow. I like to have that cash-based relationship with the companies that I'm investing in. And, dividend stocks come in all different shapes and sizes as well. You've got ones with lower starting yields that raise their dividends aggressively. And then those are probably going to be more akin to like classic growth stocks that people like to. When you think of a typical growth stock, you think of, I'm kind of tying my tongue's getting tied over this, but when people think of growth stocks, I think add a dividend to that and you've got dividend growth stocks. I know that was kind of a dumb way to put it, but like for example, okay, let's go back to Visa. I think Visa is just a great example of this. So you look at this and you think, oh, that's a growth stock. That's a growth company. But it also just so happens to pay a dividend. So I'm looking for companies that have financials that are kind of like this, but also come with this. That's what I'm trying to say. And so to close the book on this tangent, sorry about that, guys, totally got tongue tied. I would advise a younger person or an older person to look for companies, just look for companies that are growing and look like they have the makings to continue growing, at least for the foreseeable future. If you can look at a company and think that it's predictable enough and easy enough to understand that you can predict that 5 years down the road, 10 years down the road, its sales, its profits, its free cash flow are going to be larger then than they are today. Then I think that that's just the kind of company you should be looking for. And whether or not it's mandatory for that company to pay a dividend is up to you. You know, I mean, not everyone has that same requisite. I personally do. And hopefully that answers your question. I did a terrible job. Explaining that, so I apologize. But hopefully all of that made sense. Hopefully all that nonsense and that gibberish. Kason, thank you, my friend. This is my 6-pack shirt. I got a 6-pack and nothing to do. $35 in a 6-pack to my name. And I don't know that I 100% agree with this. As a young investor, definitely growth stocks. It will move many times. Compare that to dividend. So I guess with this said, like, because clearly we're still making the distinction here between a growth stock and a dividend stock. What is the distinction here? Because I think that stocks that are growing are growth stocks, and stocks that pay dividends are dividend stocks. But you can have stocks that fall into both camps. And so what would be an example of a growth stock? What would be an example of a dividend stock? And I think we should stop making it so black and white. I think that these super exclusive labels make things a bit confusing, and also a bit tribal too. I mean, I'm saying that as a dividend investor. But by that, I just mean I invest in companies that only pay dividends. But companies that pay dividends can also be growing, and they totally should. So, like Snap-on, here's another example. Let's stray from Visa for a moment. I think Snap-on has been a very growthy company. Its sales, its earnings, its free cash flow have done a great job growing, but it also pays it a nice dividend, about a 2.5% yield or something like that. I think my yield on cost with it is like 3.5, much higher. And that dividend is growing very aggressively. So I think that's another example of a stock that really falls into both buckets. So I don't know. Let's see. Andrew says both. Yeah. Let's see. Bowser, things still going well with the Walmart storefront? Yes, they are going fantastic. So I'm going to put out a video sometime in June going over just kind of like giving an update on the store. But here's where things are at as we kind of close out the month of May. So at this point, I have sold through all of my inventory from my first round of inventory, I suppose. So all of that has been officially sold out as of like Friday. And I'm waiting for more inventory to be shipped into my store. So the money that I sent in in April, all of that inventory has just sold through. And I'm waiting for the money that I sent in May, the inventory from that to be sent into my store to then be sold. Hopefully that makes sense. Hopefully that wasn't too confusing. But as far as the numbers go, that first round of inventory spent, I put in $2,000. My total profits, the total amount that's going back to my bank account from those sales is about $3,200. So if you subtract my initial $2,000 inventory spend from that $3,200 number, my excess profit there is about $1,200. So 1,200 into 2,000, that's about a 60% return on that invested capital. So basically invested 2,000 to make 1,200 excess. Pretty solid first month. We'll see how the inventory spend for May does. I'm not expecting the results that I've seen so far. I'm not expecting them to be that good every single month, but it's cool to know that it's possible. I'm kind of expecting really like probably a 10 to 20% return on investment on a monthly basis or so, which is much lower than the 60% that I've seen in my first month, but still very solid. I get it. So the question here is, okay, so the distinction is growth stocks are thought to have bigger growth, for example, NVIDIA or Palantir. I see. So I almost don't know that I would I don't even want to label it, but I think more than anything, those stocks are, how do I explain this? People have seen very crazy returns with those two stocks in particular. NVIDIA was, maybe it still is to some degree, but it was the it stock for a period of time. Palantir is the it stock right now. There's always going to be some sort of it stock, the hot stock of the moment, the popular girl at the party. And those companies are growing, but I think that when it comes to the share price returns, we can debate on the degree to which this is true, but at least to some degree, the share price performance is driven by momentum and sentiment than it is, fundamental performance. And so if the question then becomes, should I invest in companies where there's momentum? Should I invest in the companies that are these it stocks? Should I invest in those high momentum stocks, on very trendy stocks? Should I invest in those, or should I invest in kind of maybe some of the other stocks that I was describing? If that then becomes the question, I don't know. I think that it's a different type of approach to invest in these momentum-driven stocks and momentum-driven companies. That's personally something that I avoid doing just because there's more timing involved. You have to time the purchase right. You have to time the exit right. I guess that's true with any company, but like on the other side of things, we're buying companies to hold on to them, not to, flip them in a short amount of time. And I'm sure that some people are buying into things like Palantir and NVIDIA to hold on to them too. But undeniably, there are people who are buying them just because they are the hot stocks right now, and they'll flip them as soon as they get cold. So I just think that's a different conversation, and I think it's just a different game. I think that buying the momentum stocks is a different game altogether. All right, guys, I'm scrolling up here in the chat. Fast Eddie, what is your question here? Name me a company that paid a dividend on day one Since the company pays a dividend when they first start off, they're all growth. I just don't get this growth label though. What's growth? A growing company? I mean, you should invest in growing companies no matter what. So, based on that way of thinking, you should buy growth companies. I don't know. These labels, I think we're just getting too hung up on these labels. Buy stocks that you understand, that you think are interesting, that are growing, and it seems like their long-term prospects are favorable. Don't worry about the labels. Just follow that blueprint. And any other specific requisites that you might have, whether it's the presence of a dividend or a certain return on invested capital, or certain free cash flow yield or PE ratio, that's totally up to you. But generally speaking, don't worry about whether you should buy growth stocks or dividend stocks. Just buy companies that you understand, that are growing, and hold on to them. Don't overpay for them. That's it. I think you could find yourself getting into kind of like we've done today. You can find yourself going back and forth, this or that, A or B, black or white. You can find yourself wasting so much time on putting yourself in these buckets, these pigeonholes, and you really don't need to. Anyway, guys, I think this is a good place to wrap it up. I plan on only going for about 30 minutes or so, but we got a solid 45 in. Pretty good for a nice little impromptu live stream. Almost 200 people in the chat. I will take that. Before we wrap it up, though, I want to know, what do you guys have going on the rest of the day? Are you guys doing anything fun, anything crazy for Memorial Day? Any big plans? Are you guys just relaxing? JJ's going on a hike. Good job. Good job, Jeff. Glad that the colonoscopy went well. Yeah, a lot of you guys just relaxing, it looks like. Very nice. Scoop's going to be doing some soft sobbing. Good luck with that, my friend. Nice. Tony, your boy checked out my boy's new house. That's awesome. Ooh, Inglorious Bastards. Good movie. Alfredo's working. Good job. Oh, it's raining in Kansas City. Okay. Man, it could not be a nicer day here in Vegas. Looks like there's a bit of a breeze. It's getting hot, though. It's getting to be in the 90s here. I think by the end of the week, it'll be up to about 100. Nice little disc golf. Good stuff. Nice. Christian's hitting the gym. Christian, what gym do you go to? Because you're in Vegas. You're in Vegas too, huh? Craig's here. What's up, Craig? Man, congrats on the that like relay race that you did. That 100-mile race that you did. That was really cool. Looked really cool. And how was that experience? Like, what was the breakdown too, actually? So like, because I know there's a team of you guys. You guys ran 100 miles. How are you divvying that up? Do you run like, a certain amount of miles and then you tap someone, kind of tap someone in, take a break, and then kind of just keep doing that? How does that work? Because I see a lot of people do stuff like that, but I've always wondered how that gets divvied up. Phil's at the gym doing a little lower body. Nice. That's what I got to do today too. Richard with a little gin and tonic. Nice. Wow, Sigurd, quite the run today. Holy cow. I want to hear what Jim Christian goes to if he's still in here. Nice, David. Congrats to your stepson. That's awesome. Oh, you go to EOS? Nice. I do too. Nice, man. I go to the EOS. I'm on like the northwestern side of town. And so I go to the EOS that's right off of Durango. It's on like Rome Boulevard or something like that. But there's another one that off of Craig that I've heard is really nice too. One of my friends goes there, so I was thinking about maybe checking that one out sometime soon. Okay, Craig says we ran about 16 to 17 miles each, 2 to 5 miles each leg. That's not too bad. And is that all in one day, or how does that work? I'm guessing it's probably all in one day, right? Oh, nice. You guys just bought a Peloton. Good job. Dom's cleaning, so don't end the stream. We'll wrap it up in just a minute. Oh, the one on Stephanie in 215. Okay. Cool, man. That's very cool. Very cool. All right, guys. Now we're officially gonna end it. But I want to thank you guys so much for hanging out with me this last 50 minutes or so now. Fun little stream. Kind of fun just to kind of fun just to hop on here every once in a while and plan. I'm glad I did this. So I'm glad I did it, and I'm glad I had you guys here with me to tune in. So thank you guys for hanging out. Hope you all enjoy the rest of your Memorial Day. Stay out of trouble. And also, we will definitely be doing a stream this Friday. I should have mentioned that earlier. This does not take the place of Friday's stream. So we will still do our normal Friday happy hour. So I will see you guys then, and have a good week. Hope the market's good to you guys tomorrow and Wednesday and, well, just the rest of the week. But all right, guys, I'll see you in the next one. There we go.